What's up, fellow investors? David Van Landingham, Rent to Retirement. We are with Graham from Highlands Residential Mortgage and Aaron, of course, our own, Eric Winkler. So give us a thumbs up and make sure you subscribe to our channel and take it away, Graham.
Well, thank you. Aaron and myself are going to try to help the consumer understand a little bit more about closing costs, loan estimates, closing disclosures, everything they need to know when it comes to looking at all the numbers when they're doing a loan. The industry itself has had a lot of changes over the last, say, 10 years. At one time, before the government stepped in after the '08 bust, I guess around 2010, they tried to change everybody on more of a uniform type of a delivery of information. Everybody's heard of a thing called a good faith estimate or a HUD settlement statement. Well, those terminologies in the Fannie Mae world went away about, say, 2010. And then they came out with their own, it was called the TILA or the RESPA, which is the basically the good faith estimate. And it was a nightmare to try to understand. So we kind of chugged along for a couple of years. And about 4 years ago, they have a thing called TRID that came out. That stands for TILA, RESPA, Integration Disclosure, which is really good because it really made it a lot more easy to understand for the consumer. Every lender had to do the exact same thing because there wasn't one good faith estimate over here looking like this and another lender looking like this, and the consumer scratching their head goes, I still can't figure out how to compare. Well, the loan estimate, you have to do it exactly the same way every time, and it breaks it down by categories, which is what we're going to show you today. So what takes place is when we get a loan app and we're ready to trigger the loan application. What that means is we have the application, we got the contract, we're locking in the rate. Now we're going to shoot out the disclosures. The disclosures have to be sent to the consumer within 3 days in accordance to RESPA once we trigger the loan. Triggering is having all those components, locking it, and then we send out the disclosures. You're going to get 25 pages worth of information, but you're also going to get a thing called a loan estimate, which took the place of the good faith estimate. Okay. The reason why we're doing this tonight, because we want to show you as a lender, our fees are the same wherever you go, whatever state you go in, whatever you buy. They're always going to be the same, which is categorized in section number A. We'll get that to in a second. But when you go to other states, the states will dictate the third parties, okay, the things that we don't have control over: title fees, recording fees, appraisers, surveys, all these things we have no control over, but we have to guesstimate or estimate, should I say, as close as possible on the loan estimate. So with that, I'm just going to go ahead and transfer our screen over to that part right now. I'm going to turn this over to Aaron, and we're just kind of going to briefly go through here. Aaron, I'm just going to scroll down and you can just kind of take it from there. This happens to be one in Alabama, and we did that for a reason because we want to show you the differences by state.
So as Graham alluded to, whenever we originally lock the loan in, we're required to initially disclose the terms to the borrower in order to, quote unquote, officially start the loan process for the individual. Up front, this early in the process, there are a lot of items that are still unknown to us as the lender. As Graham said, we have to estimate a lot of this stuff with our best guess before we find it out a little bit further into the loan process. So all of those items, just to recap, are going to be things like the homeowner's insurance, property taxes, title insurance for the state that varies greatly depending on the state, the fees that the title company might have, any other type of rent credits, prorations, home warranties, all of those kind of third-party fees that we don't know are all estimated upfront this early on in the process. So
this right here is the sales price for the property. This is the loan amount for the property. This is the interest rate that was locked in, and then it will dictate just the principal and interest. Doesn't include the taxes and insurance, just that, and we'll get to that in just a moment. And as you can see, when we get down to here comes the taxes and insurances right here, which we've determined is going to be whatever the tax bill is and the insurance bill annually divided by 12. That's what it comes out to. So there's your principal and interest payment here, which the 150 matches the same thing up here, which is the escrow fees like I just discussed. Now, here's where the biggest mistake is made by the consumer. They come over here because we tell them how much the closing costs are going to be. So they come over here and they look at this right here and they go, wow, that's $6,300. I thought it was going to be closer to $3,000. Well, one of the things they miss out on is they don't look to the right here, which includes $4,300 in loan costs. And then, of course, the rest are in prepaids, which is what we're going to talk about next.
Perfect. So if we go down to section A here,
Section A.
Yep, section A right there in the top left corner. So that's going to be everything that we know up front as the lender. That's the charges that we are going to collect as the lender. Those are set in stone as far as our origination fees. We'll talk the points here in a second. That varies. That's completely up to the borrower. But as far as our fees, for example, at Highlands, if you add together this administration, closing, processing, tax service, underwriting, that makes up the fees that we collect as a lender. All in, that's $11.94. That doesn't fluctuate based off of sales price or loan amount or state location, anything like that. So we know what our fees are, of course, at the beginning. We have control over them. So this section A is not going to change at all. We'll see that when we take a look at the final closing disclosure here. That won't change. The only area that could change is maybe the buy down. If the borrower comes back and decides a week after this, oh, I want to buy down a little more than a point. In this case, the borrower opted to buy down a point. On almost all our transactions, we have 0 points here, so we don't even see that charge there as well. If we jump down to section B, that's going to be everything from the appraisal, credit report, and the flood cert. Those are all basically third-party fees that we run as the lender in order to complete our job.
One of the things on section B is I want to point out is we put this final inspection in. And the reason why we do that is because Rent to Retirement is working with a lot of builders out there. And in the builder world, a lot of times we'll get the appraisal as soon as we possibly can before completion. But 99% of the time, the appraisal will go out and there's usually something missing, shrubbery, a bush, or a tree, a door, something that's not complete, but the appraiser goes out and gives the value, takes some pictures, it comes back, says that it comes in at value or higher in most cases with Rent to Retirement, but it's not an as-is appraisal. So they have to go back out once they completed the property. And typically that takes place when the builder gives a CO, which certificate of occupancy, meaning it's ready to go. The city says, we like the property. Send the appraiser back out. He takes a snapshot of that window or that door or the driveway that wasn't put in. That's where that trip fee comes in for the final inspection of the $200. We put that in there every time just to be safe. And the reason why we do this, because the government requires us to be as accurate as possible. If anything changes from the loan estimate to the final closing disclosure, and it goes with outside of the tolerance level, we have to kick out a thing to the borrower. It's called a change of circumstance, which means if the rate changes or one of the APR items that we're discussing right now goes higher, a title fee goes higher, appraisal goes higher, whatever the case may be, whatever spikes that needle that we hit outside the tolerance, our team has to shoot out another loan estimate, very similar to what we're looking at here, to the borrower, explaining that, hey, things have changed. This is where they are now. If we don't do that, then we get a lot of trouble from the regulators. So we put that $200 in there just as safekeeping. That doesn't mean it's going to show up at the final closing table, especially if you're working with a turnkey product.
Yeah, as we jump down to section C here, this is going to be everything related to the title company and the fees that they charge. Some of the fees that also flow through the title company, like the titles insurance, for example, that is ultimately dictated by the state, the rate set by the state. So while the title company has their own set of fees, which we're just purely estimating, upfront this early on, there's also some state fees that flow through on this section C as well that ultimately go through the title company. So long story short, everything section C here is to do with the title companies and the fees that they collect for either themselves or behalf of the state. and these are still estimated at this point in time.
Now, this is where we're going to show some significant differences by state, because it does vary quite a bit by state on here. But if you can recall, when we looked at that very first part of the page up here, and we'll go back up, when we say that $4,300 for cost, well, there it is at the bottom, $4,300. And then the rest of it is all over on the right-hand side. I'm gonna let Aaron take it from there.
Exactly. So briefly, Section E is also all state fees right here. So that could include things like recording fees, transfer taxes, things like that. Those will vary also, greatly in accordance with the state. So Section E is also kind of lumped together with those title and third-party fees. If you look at Section F and Section G right here, these are everything to do with what we call prepaids or the escrow account. So again, these are still estimated at this point, but they do give the borrower kind of a good estimation on what to expect as far as what's going to be collected on those. For example, whether it's a purchase or a refinance, we have to make sure that 12 months of that homeowner's insurance policy is paid at closing. So right away, if, for example, the borrower has a $100 a month insurance policy, well, we're collecting $1,200 at closing so that we can pay that policy in full, which is required. So while that can, at times, especially if you have a higher dollar amount property, that can be a pretty big expenditure there, which is essentially the homeowner's insurance. The borrower has to pay it either way. Section G here, a lot of borrowers get confused with the Section G, and that is everything to do with the escrow account. The whole premise of the escrow account is, of course, we collect the homeowner's insurance and the property taxes. That's part of the borrower's monthly payment and additional to their principal and interest. And they do that so that at the end of the year or whenever their homeowner's insurance is set to be renewed, they don't have to worry about getting out their checkbook and cutting that themselves. The loan servicer will do that on behalf of them by way of the escrow account.
Let me talk a little bit about escrow accounts. Escrow accounts are optional, okay? Yep. I would say probably 99% of the time we set up the escrow account for the borrower as a convenience. A great example, I'm talking to one of my dear friends. He's an accountant, he's an investor, and he's actually part of the Real Wealth. He's one of our private lenders as well, but he's got over 400 properties. And he still has like some small mortgages on there for like 20,000. And I said, why don't you just go ahead and pay them off? He said, why? Because I have an escrow account and they're taking care of my taxes and insurances. They are actually as a convenience. When you have multiple properties at the end of the year, do you really, come Christmas time, do you really want to start writing out those checks and be a bah humbug? I don't. I'd rather for the servicer to send those checks out. And let's say the tax bill didn't get sent to me and it got sent to my neighbor and I didn't pay my tax. And here comes the taxing authorities a month later in January say, you owe the tax plus penalty. Well, guess who has to pay the penalty? Me. But if the servicer is servicing it through an escrow account, you don't have to worry about any of that. A lot of people miss that. Okay. Sorry, I had to throw that in.
Yeah, and one other thing I would kind of elaborate on that with is with this Section G, we can sometimes see that vary pretty substantially, just depending on the time of the year and when the property taxes are due. For example, if it's a loan closing in September, October, the servicer is going to have to turn around and pay those property taxes come December, January. So sometimes we can see, typically it's 3 and 3 months we see collected there in the cushion, but sometimes we can see 6, 8, 10 months collected so that we can pay that bill whenever it's due. Section H down here is again a state fee, the owner's title insurance. How the loan estimate works, it just flows through ultimately through this other section. The owner's title insurance is by definition a optional piece for the borrower. 99.9% of the borrowers, I would say, opt to get that extra coverage, but that's why it flows through over here. The rate does vary based off the state, so that's one of the items that we get verified by the title company. But it is important to keep in mind that is ultimately an optional item for the borrower.
Let's talk a little bit about that optional thing. There is a thing called, and I'm going to refer over here, see where it says lender's title policy in Section C. we as a lender require a title policy as well that actually piggybacks the owner's title policy. Okay. If you opt out of the owner's title policy, which would be extremely foolish, we as a lender still have a vested interest. Our number is going to go up in value. So people trying to save money and pinch pennies, don't do it, because A, you're going to shoot yourself in the foot, because if you don't, as a buyer of that property, do not have an owner's title policy, I can't begin to tell you how many times that saved borrowers on, like, let's say a builder that decides that one of his subcontractors came in and decided to put a lien against the property because the builder didn't pay him. There's a $7,000 lien there for some contractor that wanted to get paid. He didn't get paid. He put a lien against the property. If the title company did not offer or run a title search and provide the title policy, guess who has to pay that lien? The new owner. Okay. So this is very, very important, guys. Even though it says optional, you got to have it. Okay. That's all there is to it. Sorry, Aaron, go ahead.
Oh, perfect. So if you scroll down a little bit further in the bottom right-hand corner, now we have this calculating cash to close section. And this ultimately is giving us a snapshot of really everything that we just looked at on the first 2 pages. The loan estimate is really only ever going to be 2 pages. So this is pretty much the entirety of the loan estimate. So right here, we can see in the first line, it gives us our total closing costs. It gives us the down payment that the borrower's putting down. If there were any additional credits, earnest money, things like that, we would all see it here. It just hasn't been verified at this point in time. So that's why we just see zeros. It's demonstrating a worst case scenario to the borrower, pretty much the highest potential cash to close that we're estimating as loan officers on the front end. So that really in entirety is the breakdown of the loan estimate.
So now what we're going to do is we're going to switch it over to the final closing piece. What happens is when we're ready to go, we got the title policy in, we got the appraisal in, we got the underwriting, got the insurance, we're ready to go. We've got it in for clear to close, and all of a sudden we send out a closing disclosure. Now I'm going to switch over here. Notice that Alabama, now it's closing disclosure. Okay. Very similar numbers that we looked at earlier. Okay. But what takes place from when we send this to you by law, that thing I mentioned to you a minute ago called TRID, the new TRID law requires you to acknowledge, don't have to agree, but just acknowledge that you've seen this document, which is called the closing disclosure, because this is a preliminary closing disclosure. It'll be sent to you electronically. You click off on it electronically. Once you click off on it, it transmits that back to our system and date stamps it showing that you did it. And at that point in time, you have to wait 3 days to close by law. So during those 3 days, what the initial closing disclosure sent is our closer, the title company, are going back and forth looking at these numbers. Okay, the insurance changed, the taxes changed, some items changed, whatever the case may be. They're tweaking this all the way down to, okay, now we have a completed and final closing disclosure, which in our case is something that Aaron, as well as the title company, will send to the client stating, this is your real McCoy, this is your bottom line. But we're going to show you some of the differences from when we did the initial LE, the loan estimate, to the closing disclosure. Okay. So we're really just going to jump to the second page.
Yep. And Graham, if we let's go up just a hair bit here to the escrows, I just want to point out. So on the example that we just looked at, you can already see our final monthly payment has changed. So while principal and interest, I'm not sure exactly what that was on the front, but
it was $150.
Yeah. So we had $150. Now we're at $205. We've gotten the insurance policy in, we've gotten the property taxes in. So we've already seen the impact there for the escrow account. $205 a month is now being collected. Go ahead, Graham, down to the second page there. If we look here, the great thing that I love about the closing disclosure is now we finally get a full breakdown of buyer and seller paid items. The only area we really would have seen anything seller paid on the loan estimate would be in that first bottom right-hand corner on that second page, where it would show any types of deposits or credits, and they'd all be lumped in, and we really wouldn't have any clarity on this. As you can see, as he kind of scrolls throughout it, we have a whole seller paid column So anything like title fees or property tax fees that are owed by the seller, that's all going to be reflected in that way. So if we go up to the top here, section A, again, these are the fees that we know. We knew these weren't going to change. These are our lender fees. We're still at $11.94. And then of course, there's the optional buy down by the borrower. Now, if we go to section B, the appraisal cost, now we can see that it's actually this right-hand column here that 525 is, and that's actually been now moved to paid outside of closing. The appraisal piece is the only item as the lender that we require the borrower to pay upfront and outside of closing. On the front end estimates, that actually is still factored into their bottom line cost. Now on the final closing disclosure, we're able to move that cost over, and then that's now reflected paid outside of closing. That's not being factored into their total down payment and closing cost. So we're already starting to see some fees decrease in that regard, or not decrease, but they're accounted for 100% properly at this point. In this case, a final inspection was required. The home wasn't fully complete when the appraiser went out. So that's why we still see that final inspection charge of $200 included. As we jump down to section C here, we now have the fully finalized and accurate title fees. So if you can look there, there's a substantial portion that is to the right here, and that's being paid for by seller. That's all coming ultimately from the contract and any negotiations that might have taken place there that the title company has now relayed to us as the lender, and that's accounted for properly here. So that's where you can see any of these title fees split up, as well as we also have the accurate title insurance numbers in here as well. And you can see that that's being split 50-50 between the buyer and seller in this case.
Let's toggle back to the beginning. See where those fees on the title, only $1,180. Now here's the real McCoy. A lot of changes there. Okay, that's what we're trying to tell you. A lot of changes, and this is where the title company and the closer are tweaking these numbers to make sure it's 100% in accordance to the contract, the agreement, the state, everybody. Okay, sorry, Aaron, go ahead.
Exactly. Yeah. And then section E again, which kind of trails off that, is again our recording fees, any transfer taxes, any state taxes, city stamp tax, anything that in that regard is now fully accurate and finalized there. So we see that that's come in. Section F and G are again our prepaid items and the escrow items. And we can see here that section F, we've got 12 months collected for their insurance policy, and that 1040 number there is whatever annual premium the borrower ultimately selected after they did their homeowner's insurance shopping, what they felt comfortable with. That is the number being factored in right there. Another item just to point out there, you see the prepaid interest on line 3 right there under section F. That's just the daily interest on the loan in accordance to when the loan closes. So depending on the closing date and the month, you're going to see that, kind of fluctuate. So that's just the interest on the loan. Section G here. So here's a situation, just what I was kind of alluding to, where depending on the time of year, the property tax bill might be owed, might be collected, and that can really skew numbers sometimes. Even though it's still property taxes, it has to be paid at the end of the day. So here we can see homeowners insurance, we're collecting additional 3 months. The rhyme and reason behind that is when the insurance policy renews next year, if there's any type of increase, which we all know typically there is with insurance policy, even slightly, they're just trying to avoid an escrow shortage there. So when we go pay the annual premium when it's due in a year, or the loan servicer, if the loan's sold, what they're trying to avoid there is calling up the borrower and saying, oh, hey, you need to cut us a check for $1,000 so we can pay the rest of your policy. So we're just trying to avoid any surprises there. The property taxes here, if it were, I guarantee this loan closed towards the end of the month, the property tax bill was due. That's why we see 13 months actually collected here for the escrow account. If it were towards the beginning of the year, if the bill weren't due, we'd see a typical 3 months there. In some cases, like Graham said, keep in mind this whole section G here is completely optional to the borrower. If they want to pay these bills on their own and be responsible for it, this can always be opted to be waived. And of course, that would reduce your overall cash to close. still have to pay it one way or the other. We're just helping you with it. But keep in mind this section G here is fully optional. Again, section H, we see that title insurance pop in again that Graham covered. It is optional, but almost everyone goes with it for very good reason. If we scroll down to the next page here, we're going to come back up to this calculating cash to close because I really like the breakdown that gives us. But if we keep going down and we look at, and this is essentially the last page of all these substantial items in the closing disclosure. So the top left-hand section here, scroll up just a little bit, Graham. So section K here, this is really just recapping what we already saw on the first 2 pages there. If we scroll down a little bit, section L is going to be where we see any credits that are essentially coming back to the borrower. So in these numbers, we consider the earnest money. So what they paid at the very beginning when they reserved that contract, that's a credit back to them. Our loan amount, we're crediting that back to them to ultimately make up what's owed at the transaction. A really important and noteworthy item here to take a look at is if we look at this adjustments for items unpaid by seller. Line 13 right there, $1,000. A lot of borrowers think right away, what am I getting paid? Why am I having to pay another $1,000 right here? This is actually a credit, a straight cash credit from the seller back to the buyer, paying for these property taxes. Scroll up just a little bit. Let's go to the page before this, Graham, and let's go back and look at the 13 months we're collecting for the escrow account. Keep going up a little bit further right there. So if we look at the 13 months there, as we were kind of going through this, a lot of people were probably wondering, well, why is he having to pay 13 months of taxes? Why is he having to pay that tax bill is due at the end of the year if he's just now taking ownership of the property? Well, when that's a $1,500 number there, we scroll down and there's a small cushion there, 3 months. But right here is $1,034 from when the seller owned the property January 1st to our closing date, which is August 12th right there. So all the taxes that he was responsible are being credited back to the borrower in the forms of dollars and cents. So he's not paying any property taxes for when he didn't own this property. So a lot of people can get caught off guard by that 13 months, or sometimes it's 9 or 8 months, but then we scroll down a little bit further and this makes it right here with offsetting it with what they don't owe. So that essentially is the bulk of the final closing disclosure. If we look at the whole right-hand side of the page here, scroll up just a little bit, Graham. This gives us, that's basically just anything that's going to be paid for by the seller. So as the buyer, as the borrower, you're not really looking at that section M and all of that. Anything that is a credit from the seller is going to flow in through your side, and you're going to see it on the breakdown, just like you saw those property taxes. Graham, scroll down. I want to show one more area. Scroll down, keep going, keep going, keep going. Stop right there. So this is favorite section to probably kind of outline to the borrowers where we started at the beginning and where we ended. So if you glance at this and we look at the bottom cash to close, ultimately when we first disclosed this, when we were kind of estimating the all-in cost to the borrower, we guessed $43K and $300 all in. Turns out after we got everything finalized, everything shored up, that went down $3,000 essentially to $40,000. Now, sure, part of that is we can see the deposit right there, earnest money. The borrower paid that either way, but that's info we didn't have at the beginning that ultimately went, contributed towards trimming down the final cost to the borrower. So that's kind of the all-in-all breakdown as far as what we see at the beginning from the loan estimate to the final closing disclosure.
So the bottom line is that you can see there's always going to be some changes from the initial loan estimate until the final disclosure. Okay. I'm going to break away from this just for a moment, simply because I want to bring David back into the picture, because I know he's anxious to talk, but it's a very fundamental type of form that's uniform for all lenders. Okay. And if you're out shopping, I got a loan estimate from this guy. Well, I got one over here. The true tool will tell to measure a lender from one lender to the next is only one section, which is right here. Okay. Everything else is the same,
And that's the section A, just to clarify.
Yeah.
We couldn't see Graham, but that's that section A. Mhm.
Everything else will be the same regardless of where you go. Okay. So that's one of the things I just wanted to point out. But other than that, David, if you have any closing comments, I welcome it.
Yeah, I mean, this is exactly why, if you look at our performance that we do at Rent to Retirement, we estimate these closing costs because we only know so much of it, right? And now we just took a peek beyond how much more there is that we just don't know. We know certain factors that are going to be in our closing costs, but all these other ones we don't. I think a lot of times the clients see the prepaids, right? And they freak out on those. Those are things
Sure.
they're going to be paying anyways, right? So this is very helpful.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.